Well, as we always say, we know we don't know, but I want to be very mindful of what the trend here is. And remember, we think about Thursday, big up, Friday, big down, today, big up. I mean, that is price action that to us is still more endemic of a bear market than a bull market. And we're only 2 weeks removed from what was that huge two-day rally that Monday and Tuesday. And we're only a few weeks removed from that post-Labor Day move. So, calling these bear market bounces is really difficult business. I think it's reflective of just how exhausting bear markets are. So we take a step back and just say, okay, let's not forget the trend. Most stocks are still below downward sloping 200-day averages. I think until that changes, you got to be very, very careful with how aggressive you play these bounces.
I mean, the bear market can still be fully intact. I hear you on the trend, but if this can actually last for, I don't know, there are some projections that you could get a 10% move in stocks if interest rates start to come down a bit. Why would I want to sell in the face of that? Now, I'm not suggesting that anybody is great at timing anything, but still, if I think that it actually can last, why should I just sell out of everything at the moment that I have an opportunity to? Well,
Scott, I think what's interesting about the question is really that the justification for a lot of today's move was yields down, but actually, where did yields close? You had a complete round trip on bond yields. 10s closed above 4%. I think 30-year yields closed up. I mean, this year, the entire year, has been about rates and FX. What also closed at the high today was dollar-yen, right? So the things I would look to from a macro standpoint to say that there's a change really haven't happened. And I think almost more important than whether the next 150 or 200 points on the S&P is higher or lower is what the leadership looks like. And that's another thing that really hasn't changed over the course of the last several months. Kind of our thinking has been that the risk to the market comes from the top, comes from the big weights. And that's been true both on up weeks and down weeks. It's been the top of the market that underperforms, the Apples, the Teslas, the Amazons, the Googles. So I think the leadership and the macro are really unchanged here.
Well, see, I guess I would counter by saying, okay, you're right. Rates moved off the lows. You're right. The dollar moved off the lows. And the fact of the matter is that the stock market held in there pretty well, at least showing some level of resiliency that at times hasn't existed.
Yeah, and I think, when you go back to Thursday's move off a weak CPI print or a hot one, you have to respect any time the market responds to news differently than you might expect. So certainly want to respect that. But go back to that rally that we had this summer, a very big rally from June to August. What didn't take the bait was the macro, right? You really saw no change in FX. And rates very quickly started to move higher again. So I think if we're going to give this move, this current bounce, which is maybe at best 72 hours old or 3 sessions old, if we're going to give it credibility, we need to see improvement in the macro. And I think that comes from rates down and dollar-yen down. And we haven't seen that. This has been a macro year, and I think the macro is still largely intact.
Your point is totally fair and makes complete sense to me. What happens if we retake some of these critical technical levels, like the 200-day moving average? Is that a game changer?
Well, it's a long way away, so let's start a little bit more modest than that. That big rally we had 2 weeks ago, Monday, Tuesday, 38.05 was the high on the S&P that week. I think that would kind of be the first threshold to kind of evaluate where we are. Let's call it 285 on triple Qs. So 285 on Qs, 38.05 on S&P. I think if there's an index that's actually acting a little bit better here, it's really small caps. I mean, IWM did not make a lower low last week, so I want to give a little hat tip to the relative performance we're seeing from small caps. It fits my theme of own the average stock, not the index. Our call all year has been be different than the index. It is the index that's at risk. There are things to do, I think, at the stock level.
Yeah, no, it's why we have a segment coming up about small caps and the outperformance before we get out of here tonight in overtime. Chris, I appreciate it very much. That's Chris Verrone.